With the recent market turmoil comes the inevitable worry for investors about your portfolio of investments. Do you sell out and take the safety of cash, or do you stay fully invested and possibly tweak your portfolio to manage to ride out the rallies in areas of the market that you had not previously considered? Whatever your strategy, when there's a market rout, there will be some stocks that have been taken down for no reason other than that they've been part of this sell-all strategy. Welcome to today's Trade in the Markets podcast. I'm Jeremy Naylor. We're talking now to a portfolio manager who specialises in AIM stocks, particularly those that attract inheritance tax benefits. Chris Boxall from Fundamental Asset Management. Welcome.
Hello, nice talking to you.
Chris, big question at the start. Do you stay fully invested in this sort of market? We've just seen the Russian invasion of Ukraine. A lot of question marks about where the markets are going. Do you stay fully invested, but look out for opportunities to switch into areas that may now come back into fashion? Or do you think there's a reason to sell out completely and take the safety of cash?
Yeah, it's a good question. I think you need to always assess every announcement. What we're seeing at the moment is companies that are issuing mildly disappointing announcements are seeing their share prices absolutely tumble. I mean, we're seeing falls of 50, 60%. Typically you would expect a fall, but not to that extent. And these are quite big companies. But you've always, despite the unusual circumstances, the terrible circumstances, you've got to still assess how the businesses are, because they're being often they're oversold, but sometimes it might be for good reason. Things might be totally priced badly. And you should reassess the longer term. And in answer to your question, if we feel the longer term outlook becomes highly questionable, we will get out. However, and we had to do, well, this was before one of our stocks, before recent more dramatic falls, we had to get out of one of our stocks. And quite in the short term, quite frankly, we're happy we did, because it's gone on to fall a lot more. But the issue at this time is pricing. You may have to get out with a really dreadful price. And if you're really fearful of the longer term and things could get worse, it's better to run.
But there is a cost, isn't there, of doing this churn, if you like, this idea about exiting when you think the markets are going down and buying back in when you think there's an opportunity to take a rally. That is the problem, isn't it? There's a spread to pay and there are upfront costs of buying stocks.
Yeah, we don't advocate selling wholesale. It's on a stock-by-stock basis because everything's going at the moment. And as you say, there's a massive cost. And the real risk is, you're psychologically, you get out, you're sitting on the sidelines, sitting on your hands, worrying, and thinking, things are going to get worse and worse and worse. Then things start getting better, where the stock market starts picking up. And however, you're out of the market, and psychologically you think, things are still pretty terrible out there. I don't want to get back in yet. The Russians are, the atrocities are getting worse. So you stay out and you look and the market's really gone up several legs and you've been out of it. And then you think, oh no, I've missed out on the bounce. So staying in has always, in our experience and with our client portfolios, been the best things. Whilst some clients have seen their portfolios hit very, very badly, in the short term, by sticking there and not doing anything, many of them have come out smelling of roses. And this is, post-financial crisis. We've seen this, unfortunately, several times before.
It's an interesting conundrum, isn't it? And for those that are able to bear it, as you say, riding out quite often repays dividends in the long term. Do you think there's any value, especially for AIM stocks, which is, I say, mostly growth, I suppose? Do you think there's an argument for a bit of churn to try and maybe reduce exposure to some areas in this current market and go into other areas? I'm thinking perhaps maybe those with exposure to the minerals space, particularly if any AIM stocks have a pointed towards oil, for example. I mean, these are companies that are going to do so much better than the old sort of tech type companies, aren't they?
Not necessarily. I mean, clearly we're all in love with resources now because there's going to be seemingly a scarcity of it, and the resource plays are getting more attention. The same has applied to suddenly the hydrogen stocks are back in favour again. They absolutely fell out of bed over the previous months, and suddenly we're all thinking, well, we need to focus more on renewables. I mean, this is a short-term trading swing. Yes, there may be some basis for doing that, but we still like technology in the growth space just because it's had them short-term issues. And I think that from market issues, I think from a lot of the narrative around this, people have been talking about, growth stocks are out of favor because their profits are only going to evolve in, multiple years hence. I mean, a lot of the stocks we're looking at and we hold are well-established technology businesses. They've been around a long time to already delivering profits and lots of cash. So their business models are pretty well established. We're not having to wait years in the future to see the numbers. They're already producing the kind of numbers. And I would say they should continue to do very well, as could some of the resources stocks as well. I mean, going back to our book as well, in terms of AIM inheritance tax planning purposes, we don't have I'll put this in two ways, luxury or disadvantage in some instances of being out of the market. I say luxury because we have to be fully invested across our book. That's the basis of inheritance tax planning investment. And sadly, on the day of reckoning, you have to be holding the stocks. So we can't sit on cash. I say disadvantage because going back to what I was, the psychology of it all, being out of the market can often be, if you're a long-term investor, is often the worst place to be.
So if we have this volatility likely to continue for a while longer, what is the strategy? What do you say for long-term holders? What are the opportunities?
I say you should be reassessing all the time your positions. Look closely, look at announcements very closely. If the announcements, just because the announcement may result in a steep share price decline, and nearly all news at the moment seems to bring a decline rather than a rise. That's just the nature of it. Everybody gets very pessimistic at times like this, but still reassess your positions. If nothing's materially changed, stick with it. If there is a change, if growth is seemingly more constrained, reassess it based on the valuation. You've got to go. I've said before, we've lived in a sort of a stock market going onwards and upwards, full of lots of sort of fairy tale numbers and things. You've got to look back at valuations at some point, and so that's what I would assess now. With previous sell-offs, we saw valuations get very, very low, and it's been a great time to buy. So you should be looking at things in a similar light now, because there could be some really great opportunities.
Yeah. Using data you provided for this interview, I think I can say that the AIM index overall is down 27% from the early September 2021 highs. The AIM 100 is down 30%. When you say that larger companies have been hit harder than the smaller ones. Just give us some ideas of stocks that you think it's worth discussing in terms of how far down they've come and how much value they appear to you, given the declines that the stock price has seen.
Yeah, I think it was surprising that the large companies have been hit, maybe because they're more liquid as well. But I still think you can find a lot of good quality AIM companies in the larger ones. A lot of people like to sort of bottom fish think of the smaller ones, but I think the quality is still there in some of the larger ones. As a generally speaking, we look at well-established, profitable businesses, proven business models, and also I would implore people to forget about the returns over the pandemic. That was a bizarre, unique period. We're hopefully coming out of things now and focus on the future prospects. You've got to ignore that weird period of trading. So, I mean, one stock we've got here, whose shares have been smashed a bit lately, CVS Group. It's a veterinary services group. It's a large AIM company, still billion plus market cap. It's now, I think, I don't know what your charts are indicating, we're saying about 40% off highs, September highs. There was recently, it put out an announcement that the Competition and Markets Authority was reviewing a purchase of a business that it bought, a group of veterinary surgeries. And the shares fell about 20%, I think, in the day. Over 200 million, I think, was knocked off its valuation on that news. And the news related to some practices that represented about 2% of its business. So 2% of its business risk resulted in a 20% knock to its valuation to go, to add to the weaknesses before then. Look, there's been a pet boom. That hasn't gone away. Loads of people's pets are going to need care. And CVS has got a terrific network of practices, surgeries. It's got lots of other initiatives. It's got pet insurance, pet crematoria, referral centres, laboratories. It's got 450,000 members in its healthy pet care scheme. Going back to what I was saying before, valuations, the free cash flow yield this business is generating is about 3.5% to 4%. It's a good company that you can now pick up at a more modest valuation.
That's CVS Group, ticker symbol CVSG, for those that want to find out more about this. Chris, are you invested in CVS Group?
Yes, we are. It's an example, actually, of a business we invested in IPO, and it proceeded to sink about 25% after IPO. So we've been in there. It's been around on the market now for a while. And we've invested and continue to buy. We like this stock. It's got good newish management team at the head, at the top now, and it's been doing good things.
Yeah, one of the big things since I think the January 5th highs, I think, for the Nasdaq at least, has been the tumble in some of these big tech stocks. I use the Nasdaq as an example because it's a tech-heavy index. It's worldwide renown and so forth. It's in bear market now, we know that. But looking at some of these tech companies on the AIM market, dotDigital is one you wanted to talk about particularly. And I think, using your data, I think we're down about what, 80% from the September highs? 80.
Yeah, it's been well, and a lot of that came recently. It had put out an announcement. Interim results were in line. Growth was about 10%. Fortunately, it said all the long term is going to be a bit more challenging. Growth is pulled back from 10 to about 7 to 8% top line growth, which sounds quite good. However, when you're on a 40 times plus multiple for earnings multiple, unfortunately, the market demands more. And they put out some odd announcements, but lovely business, great margins, cash generation, and suddenly you're seeing huge pessimism for this stock. So we think it was massively oversold. It's high margin business, very sticky, lots of recurring revenue, 94% recurring revenue. So it ticks a lot of boxes, but suddenly it did need to re-rate because on the negative, unfortunately, it just wasn't delivering the kind of growth numbers that its valuation demanded. But now I think it's presented an opportunity. It's still, it's not as if it's not growing. It's still growing strongly in the APAC region. It was up 27%.
Are you buying, or I should ask first of all,
Absolutely,
have you suffered the downside?
We are at this level. Yeah. No, I think we are at this level. We think it just got too cheap. It was oversold.
Were you already a holder?
We were already a holder. And so we've taken a bit of a whack on it. We've held it for a while, so we're in the money on most of our portfolios. But it's been quite a brutal one. The case of probably the news wasn't as bad as all that, but it's wow. Yeah, is this thing not going to grow anymore?
Really interesting point to be made, I suppose. Going back to what we were talking about in the beginning and about whether or not you sell out or whether you adjust your portfolio or whatever. I guess this is one of the ways in which, as active investors, we can maybe capitalize on an opportunity. Yes, you might have lost 80% of your overall exposure in the market through dotDigital's declines. But I guess if you can identify these areas where these stocks have been beaten up well beyond the point at which they've become ridiculously cheap, it's an opportunity then to get back in and buy more, I suppose, isn't it, at those lower levels?
Absolutely. And you've got, unlike, say, an IP, you've got a business that you know quite a lot about. It's put out a lot of news. It's been on the market a while. So you can go back and look at it, look how it's been doing. It's quite visible as well. It does email marketing software and SMS software. And it's called Engagement Cloud. So you can go in and see who else is in that space. You can see the valuation. There's a company on the Nasdaq as well, which is trading at, 4 times the rating of this thing. And you can make a valid comparison and hopefully pick up a great little company.
Yeah. Talking about the market swings, we talk a lot about volatility. And one of your stocks on the list is a company that, as you rightly say here, benefits from volatility. That's Argentex. This is a foreign exchange management or hedging company, isn't it? Exactly how does that work and what's happened to that stock?
This stock's been really out of favour, and it's a bit of a puzzle why. It had one of its founders he sold his stake. He was very well, and he sold his stake, but it was picked up by institutions. But it does, as you say, foreign currency hedging for institutions and high net worth individuals. And given that currency is more volatile at these kind of times, it's hedging primary currencies. It's not some of the secondary. It's not the higher volatility, riskier ones. So it's sort of a low risk play. And it's trading now at a single digit earnings multiple. Even if you think that earnings maybe hit mildly, it's still very, very cheap. High margins, very profitable. It's investing in the future. It's investing in new offices. It's got a lot of cash on its balance sheet. Nice shareholder register as well. So it ticks a lot of boxes, but it's just being pulled down. It was weak to begin with, and it's subsequently being pulled down with everything else. So in an interesting, going back to, you can compare what else is on the market. There's another AIM business, and which we also hold, called Alpha FX. It's bigger than Argentex, but does similar things. A little bit more involved. It's got more sort of offerings, but around the same core currency hedging space. And Argentex is on more than twice the rating. The Alpha FX is on more than twice the rating as Argentex. So interesting one to pick out. You get a bit of a dividend here as well. You get a 3% dividend yield for those that want it.
Okay, Argentex, AGFX is the ticker, down 48% from the June 2021 highs. Let's talk a little bit about GAMA Communications, ticker GAMA. Is this one of your personal owned stocks?
Long-term holding. It's another £1 billion AIM company, so big, highly liquid. Unified communications as a service, the sort of thing that's been in growing demand. A lot of companies are changing their phone systems as well. So you get the GAMA provide this via a monthly subscription. This complete voice over IP package plus all the other IT services around it. And it's again been a great business since IPO. It's grown through both organic growth, but acquisition growth and cash flow. It hasn't had to come back to the stock market for more equity. It's funded everything through internally generated cash flows. You've had no dilution from existing holders. But as you say, now it's fallen a lot. Lots of reliable recurring revenue. Once you pay for these things on a monthly basis, unless they really mess up, you're not going to move, and you will grow with your clients as well. Great margins, 20% off, 34% of a return on equity. So it ticks a lot of the boxes we like. Always cash on its balance sheet. Expanding in Europe, that's the key thing. So it's got a big base in the UK, but now actively expanding in Europe. You can pick up a great company now for what looks at a far fairer valuation.
Yeah, we're talking a lot about companies that don't really have much of an impact from what's happening currently. And I know these stock prices have been taken down for no reason at all. And one that you've highlighted here, where you're saying there's absolutely no impact from the current situation, is the healthcare software company EMIS, which has got the ticker of the same initials, down 21%. It doesn't sound like an awful lot in the grand scheme of things, especially when you compare it against the big declines we've seen for the likes of dotDigital. But nonetheless, you think at 21% down off the highs, it's worth a punt?
I do, because I don't think it was very expensive before. It's got an incredibly sticky. It supplies into the NHS. Core NHS is a lot of its business, but also into the private sector as well. Its enterprise business has been supporting the vaccine rollout, and that's been done pretty well, I think, from a software management perspective and booking perspective. I think it's done really, really well. EMIS again, so it's got lots of sticky recurring revenue. The multiple really wasn't that expensive. And there are others on the market that are on twice the multiple. So for not a lot before, you get even more for your money now, given recent falls. Again, cash on its balance sheet. And a lot of people are talking about data analysis. Data's the big thing. EMIS has collected a lot of data over the years, and I think it's looking to do more with that. So as a data analytics play, which could be with this hidden appeal there. So it could be an interesting one. Another big AIM company, circa 700 odd million market cap. But yeah, I know only 20%, but that's from something that didn't look that pricey beforehand.
Yeah. Chris, we've got time for just one more. Any other stocks you think that have gone down sufficiently for us to start looking at bottom fishing?
Yeah, I thought I'd go down to something a little bit smaller. Everybody likes a real tiddler, and this little tiddler hasn't put a foot wrong. It's just its share price has been drifted lower and lower and lower. It's only a small business, 30 odd million market, called Cambridge Cognition. It's a neuroscience technology company. So it develops tests, digital tests for optimizing the assessment of cognition for better brain health. and that goes towards helping drug companies who are developing new cures or drugs for the likes of Parkinson's, Huntington's disease, Alzheimer's, and it's just been doing over this pandemic doing really well. There's been the pandemic has provided a sort of catalyst for growth in adoption of virtual clinical trials. So rather than having to being able to go into a hospital or go into a surgery to have your trials done, pharmaceutical companies want to measure and test things from people at home. It's a real life environment as well. And Cambridge Cognition has developed sort of digital tests to support this. It's announced a lot of good contract news, and all it's seen is its market cap sort of dwindle. And I think for business that's been trying to do this now for 30 years, it's got a lot of intellectual property, and it's only going to cost you 33 million quid. And it's 45% of its July highs. So you can buy this IP, rich business for peanuts, which seemingly has a terrific, growth pipeline. It's got a £17 million contract backlog.
And
so
you are buying?
Yeah, we are. Absolutely. We've held for a while and to buying some bits as well. I think it's a great opportunity.
Okay, Chris, I'm afraid we have to leave it there. Time's beaten us, but it's been great catching up with you. Thanks indeed for your choice of, I think, 6 stocks there, which are worth a look at after we've seen some of these stock prices beaten up. Chris Boxall from Fundamental Asset Management, thanks so much. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.